So what are the rules themselves then? So the rules have been divided into two sections. So we have any mode of transport, which covers all types of transport, which is air, sea, road and courier. The other set of rules, the second set, which we'll talk about shortly, is for sea and inland waterway, and they are very clearly different and apply to different scenarios. So for the purposes of this section, the point at which the seller hands the goods over to or places them at disposal of the carrier, or the point at which the carrier hands the goods over to the buyer, or the point at which they are placed at the disposal of the buyer. But both above points are not on board a vessel. They are very clearly beside a vessel or at the point where we hand them over to a carrier to put them on an aircraft or give to a courier. So the Incoterms we're going to be using for the purposes of those type of movements would be ex-works, FCA, CPT, CIP, DAP, DPU and DDP, and we're going to discuss each one of them. So ex-works, we talk about ex-works a lot, and many people fall back onto ex-works because it's a safe place to go. If you're quoting ex-works, it's because you generally don't know what the carriage and packing costs are going to be. So if we quote ex-works at the beginning of the journey of an order, then that's a safe place to be. You can change the Incoterm later, that's absolutely fine. So when you go to ship the products, if the customer then decides that he wants you to ship it, all you need to do is add the carriage and anything else that's important to the movement of the goods and ensure that you change the Incoterm when you actually do that. So it reflects exactly what it is that you're doing. So for the purposes of ex-works then, the buyer should be the exporter. So this is something that is not particularly well understood. The exporter then, as the buyer, should have a VAT registration and an EORI number so that he can then collect the goods from the seller's premises, load them onto the vehicle, make the customs declaration in accordance with his EORI number, and he then collects the goods and ships them back to his destination point. The seller has little or no responsibility. He still does have the obligation, however, to ensure that the paperwork, so an invoice, a packing list, certificate of origin, customs declaration information that the buyer needs to make that declaration is all there and ready for him to be able to make that declaration. So if we can't use ex-works, we would strongly recommend that you use free carrier, FCA, to a named place of delivery. And when we talk about delivery under the Incoterms, we're talking about where we pass risk from one person to another, from the seller to the buyer. So in this instance, the seller can actually make the customs declaration. He prepares all the same paperwork that he would have done for ex-work, so invoices, packing lists, certificates of origin and the like. But the seller is responsible for the customs declaration, which puts the seller in a much stronger position to be able to have that customs declaration because he owns it. And the freight forwarder that is nominated by the buyer can give the customs declaration to the seller. This also constitutes proof of movement and therefore puts the seller in a better position in terms of being liable for the VAT. The buyer still ships the goods just the same way that he was doing on ex-works. The delivery point here is loaded onto the vehicle. So in this instance, the seller is loading the vehicle and putting the goods on there ready to move. The buyer still can nominate who the carrier is. He still brings his goods into his own destination and makes sure that he has his own import clearance in place. With option B, this is slightly different. It just means there's a little bit more in terms of the carriage. So in this instance, option B says the seller is responsible to get the goods to the port or airport of exit. So he's handing over to the carrier that's nominated by the buyer, but he's actually delivering and paying for the delivery to an inland port or airport. The buyer is still responsible for the movement of those goods from that port or airport all the way through to his destination. If we want to go a little further, so each one of these Incoterms is building very slowly, and we're adding more risk, more cost, and more responsibility for each of the parties. So with CPT, this is the named point of destination, which is going to be a port or airport usually. So the seller is going to pay for the goods, recharge the freight and onto the invoice, so that the freight is then the delivery point would be the port or airport of arrival into another country. The risk, however, passes to the buyer at an earlier point, at the point where the goods are delivered onto the truck that is leaving the seller's premises. The costs go across the water all the way over to the point of destination, which has been named. Carriage and insurance paid to a named place of destination is very, very similar to CPT. The only difference here is that the insurance is sold from the seller to the buyer. If we sell insurance from one place to another, we need to generate an insurance document from our own policy, usually, and we would then supply that insurance certificate to the buyer, endorsed on the reverse, so that he can claim on that insurance policy if he chooses to. If you don't wish to sell insurance from your policy, then you revert back to CPT, or if the buyer insists on somebody else insuring the shipment, you should approach a carrier to see whether you can buy separate insurance just for that shipment. The goods are still the risk for the goods is still passing at the point that you load the vehicle. The goods are still being shipped to the port of arrival, and the buyer is still responsible for the inland clearance and haulage from the port to his destination. Be aware that that insurance policy or insurance certificate needs to state very clearly whether you are shipping from or covering the insurance from the seller's warehouse to the buyer's warehouse, or whether it's seller's warehouse to the port of arrival. Just be very clear about how you handle that. Delivered at place is a named place of destination, usually at a buyer's premises or a warehouse. So the seller is responsible for all the costs to get the goods across the water to the buyer's premises. This does not include clearance, payment of clearance duties and taxes or port charges. This is for the buyer's account. There can be issues with delivered at place if you're shipping to a country where there are delays, or can potentially be delays in getting the duty and the VAT paid in the country of arrival. Any demurrage fees can come back to the seller, depending on the agreement between the buyer and the seller about where those risks lie. And this is all part of the contract of sale. Delivered at place unloaded, and we have a named place of destination. This replaces the old delivered at terminal that was in Incoterms 2010. In this instance, the seller would potentially have his own transport and would be moving the goods to the buyer's premises. It would be applicable to goods that were, let's say, potentially fragile, and you wanted a driver, your own driver, to deliver the goods and offload them safely at the destination point. So the risk passes once the goods are unloaded by the seller at the buyer's premises or warehouse, wherever it is he decides he wants the goods delivered. Delivered duty paid to a named place at destination. So again, we're going to deliver from the seller to the buyer. The unloading is for the buyer's account, so the buyer takes the risk. We're just, as the seller, going to deliver the goods to the named point. In this instance, we, as the seller, are going to prepay the duties and the taxes. Now, you can have, or you can request, that the buyer pays his own import taxes, but this needs to be done earlier in the quotation stage rather than at the end point of delivery. Prepaying the duties it's important to understand what the duty rate is going to be at the country of destination. If you are shipping to some further afield countries away from Europe, you might find that there are import licenses required at destination. There also can be some regulations around having to have legal entities in countries where you are paying duty and tax, and this is across the world. You would need to understand what the implications are for shipping deliver duty paid into any destination. So to be clear, the seller's obligations under DDP would be that the seller provides the goods suitably packaged and labelled, arrange or contract for carriage to the named place of destination or agreed point, the delivery of goods ready for unloading at the agreed point or place, the commercial invoice and any other conformity documents, whether they be paper or electronic, the export, transit and import clearance of goods, the transport document to allow the buyer to take over the goods. The seller has no obligation in this instance to insure the shipment. This is something that should be agreed between the buyer and the seller before the goods are shipped. The seller's costs under DDP are everything. So the seller is responsible for the cost of the goods until delivered, any checking operations, for example, weighing, measuring and packaging. The seller must pay any costs relating to carriage. The seller is to pay for any unloading charges only if this is for the seller's account. Seller pays for a cost for export, transit and import clearance formalities to include licensing, pre-shipment inspections, etc. Clearance formalities also include duties and taxes. The taxes are unlikely to be recovered. The seller must pay for any cost relating to the provision on the delivery transport document. From a buyer's perspective, the buyer pays any charge for unloading unless this was for the seller's account under the contract of carriage. So you can see that the buyer's costs are minimal. It's all in the invoice that comes from the seller. Moving on to Incoterms 2020 version of the sea and inland waterway definitions. So these are terms that are supposed to be used when you have shipments that are exposed to the elements. To put this in very simple terms, anything that goes inside a container on a ship, so whether it's break bulk cargo, less than container load or full container load, you would not expect to have to use these Incoterms. We need to consider then that these are free on board, free alongside ship, cost and freight, and cost insurance and freight. These are the sea and inland waterway terms. If you're using containerized freight or anything on an aircraft, we suggest that you revert back to free carrier, CPT or CIP. So for the example here of free alongside ship, this is potentially, as an example, a barge that would be transferring oil potentially from one vessel to another. The risk passes when those two ships are side by side, and the seller would pay up to the point that those ships are side by side, and the buyer would take control of the shipment as it is completed. Free on board is an old Incoterm that many people fall back on. The free on board is the named port of shipment. So what we're going to do is we're going to mention on our documentation that the port, or the port of loading. In this instance, this would be something like a car that would roll on and roll off a vessel. The risk from the seller actually passes at the point that the car would roll onto the ship. It would be loaded, stowed and secured on that ship, and then the risk would be passed over to the buyer. The buyer then would make sure that he pays for everything else to bring the goods to his destination. So the export formalities for the seller would be that they would generate the invoices, the packing lists, look at the customs declaration or provide enough information for the freight forwarder to then enter the customs declaration in the seller's name. Cost and freight we use quite frequently, or a lot of people use it, but they don't realise that actually the risk is on board a vessel. So if you're again using containerized freight, this wouldn't apply. So we're going to again put the goods as the seller on board the vessel. We are going to load, stow and secure, and the buyer is going to take control of that shipment once it gets to the point where the costs pass at the port of destination. So the risk passes earlier than the costs do. They pass at two separate points. The buyer deals with the clearance, the inland clearance, and the charges to bring the goods to their destination point. Cost, insurance and freight to a named port of destination is the same as CFR. So the risk is going to pass for the seller once the goods are on board the ship. The costs go across the water to a port of destination and the buyer clears the goods inland. The only difference with this is that the seller is selling part of his insurance policy up to Institute Cargo Clause C, which is clearly defined now in the Incoterms. And then the buyer is going to clear his goods. He's got the insurance certificate, and if he needs to then claim on the insurance, he's got the document to be able to claim on in exactly the same way as it would with CIP. Thank you for listening. If you have any other questions, please feel free. We now have a question and answer session,